Hi, thanks for having me here this evening to talk to you. So I'm just going to give you a bit of an overview of what we see as the economic themes for the year ahead. So we're starting 2018 in a good place. Australia is now in its 27th year of economic expansion. We haven't had a recession since the early 90s, and we've now overtaken the Netherlands as the country with the longest running economic expansion in the modern era. We've got some very positive economic themes for the year ahead. There's a synchronised global upturn underway. We've also ended 2017 with a fair degree of economic momentum. We're nearly at the end of those commodity headwinds, so that's going to make it easier for the economy to grow from here. And we've also a significant proportion of the growth story looks to be more or less locked in just by the nature of those economic drivers. So I'll just start with the global backdrop. So Australia will be operating in a positive global environment in 2018, and this is probably the first time we've had a supportive global backdrop since about 2011. So more than half of the world's economies have an accelerating growth profile, and only about 4% of the world's economies are actually contracting at present. It looks even more positive from the perspective of Australia, because if we look at our major trading partners, about 75% of those are actually accelerating in growth terms. So the upturn looks pretty sustainable. We've got global trade picking up, we've also got global capex picking up, and we've got strong jobs growth at present as well. So all these factors tend to support a more sustained economic expansion. The growth skew is also positive from Australia's perspective as well. It favours Asia, and it also favours industrial production, and that tends to be positive for Australia too. So if you look at that first chart there, that blue line shows you industrial production, and you can see that that's firmly in positive territory. So overall, it's a good mix for Australia. We've also got some inflationary risks starting to emerge for the first time in quite a while. So output gaps are closing, and we've also got about 70% of OECD economies at or below full employment. So we should start to see some wages pressures emerging. We are starting to see those come through in some economies. So in the US, we're starting to see some signs of life in wages there. We've also got China now exporting inflation rather than deflation. So in that second chart there, the green line shows Chinese goods inflation. So that's now firmly in positive territory. That tends to lead advanced economy import prices, and so those are picking up as well. So we're going to be getting some inflationary pressures from that angle. We're finding that financial markets are becoming more sensitive to any news about emerging inflation trends. So just a few weeks ago, we had some very big movements in equity markets and also quite a sharp pickup in bond yields, just on the news of a stronger than expected US wage print. So we probably can expect to see some more volatility in financial markets over the months ahead as we see some more signs of inflation coming through. So just on that momentum point, so Australia's starting 2018 in good shape. So I've got a chart here of the CBA Purchasing Managers Index, or PMI. That sort of helps illustrate this point. So the PMI, it's published in conjunction with a group called IHS Markit. So they produce two PMIs for Australia, one for the manufacturing sector. That tends to be a bit of a bellwether for the economy more generally. And they also produce a services index, and that covers about 75% of the Australian economy. So a reading above 50, that indicates that we're expanding, and the further above 50 you get, the stronger that expansion is. So you can see in that first chart there, both the manufacturing and the services PMIs were lifting during the final months of 2017. Looking at the details of that survey were also quite positive too. So we're getting very high readings for the forward PMI components, particularly orders, jobs and future output. So that's encouraging as well when we're thinking about how growth will pan out in 2018. We've also got other economic and policy parameters that are very supportive. So there's been a lot of talk about low wages growth. Well, that's not so good for households. There is an upside from that. So you can see that the second chart shows you unit labour costs, and they're flat. And so that's been supporting jobs growth. When we've got low wages growth, that does encourage businesses to employ more people. It also boosts our export competitiveness as well. It helps us keep down our export prices. It should also be easier for the economy to grow from here. So the unwinding of the commodity boom, that was a significant drag on growth and a huge downside risk for the Australian economy between 2011 and 2017. So falling commodity prices, that basically resulted in what we could call an income recession. We also had falling mining capital expenditure and falling jobs in the mining sector. We had businesses responding by cutting spending. We also had governments responding by cutting spending to offset lower revenues. And we also had households pull back on their spending as well in response to low wages growth. But commodity prices have turned again and income growth has picked up. So we're really seeing that come through in higher company profits. So company profits are looking quite healthy in the mining sector and throughout the rest of the economy as well. And we're also seeing government revenues picking up as well. And looking at the federal government budget position shows where we've got data up for the first 6 months of this financial year. We're running about the deficit's about $8 billion smaller than what the government had been projecting. So at one point, Australia's AAA credit rating looked to be under threat during that period of low commodity prices, but we think now rating agencies just looking at the state of the budget and also looking at our current account deficit, which is now sort of looking at it to be around sort of 3% of GDP, which is much smaller than sort of past history where it was, say, 5% of GDP. That means we're in better shape and our AAA credit rating should be intact for now. Also, that downturn in mining capex, that's very close to completion. The decline in mining sector jobs is almost nearly over as well. So by taking out this big negative from the economy, it should be easier for us to grow from here. So looking ahead, many of the key economic drivers for 2018 and beyond are locked in. So in a sense, we can think a proportion of the growth is in a sense guaranteed. The guarantee comes from a few factors. First of all, we've got the payoff from all the investment in resources. We've also got an infrastructure boom underway, and there's also the Asian income expansion to consider as well. So just on that resources payoff, as you're obviously very aware here in the Northern Territory, we've had a lot of investment in LNG. As all that production ramps up, Australia will be the largest LNG exporter, and LNG will be our second largest export behind iron ore. And in a sense, a fair proportion of these revenues are already locked in because the gas has been sold on contracts. Just looking at that first chart there, you can just see the iron ore there up the top of the chart in orange. So we had a huge investment in iron ore during sort of the peak years of the mining boom, and you can just see that payoff coming through now, just that huge surge in iron ore production, and we should see a similar trend for LNG as well. Just on that Asian income boom, so if we think about Asia, it's very solid population growth there, and also their Asian incomes are rising, and so that's producing a spending wave which is reshaping the global economy and also the region here. So the Asian population, that currently stands at around 3.5 billion, and per capita incomes are actually greater than the global average. So this is impacting on food, consumer durables and services like tourism and education. So just looking at that second chart there, that just highlights the strength of our services exports. So the orange line shows you Asian tourists coming into Australia, and the green line shows you Asians coming here for education purposes. And you can just see the sharp pickup in both of those series. And there's plenty more to come. So just on that infrastructure spending boom, so we've got a very sharp lift in infrastructure spending from many of the state governments. It's quite a full-on chart here, but it just shows you the magnitude of the transport infrastructure spending underway. So that is still ramping up, not expected to peak until I think it's 2020. A fair proportion of that is in New South Wales and Victoria. They're mostly driving that spike. It is probably a good thing though, given the strong population growth in both of these states. So we really do need that transport infrastructure in order to keep the cities livable. So economists like infrastructure. It tends to boost growth in the short term, and it also boosts productivity and income over the medium term, and this is what our economy needs. The benefits of these projects are, in a sense, locked in. First of all, they're multi-year projects and they've already started, and once they've started, they do tend to go on through to completion. So just a bit more on that Asian income story. That's where we think a lot of the upside potential lies. So this chart just shows you how the parts of the economy are growing. They're exposed to this Asian income story. So the rate of growth there is about 3.5%, and that compares with about 2.4% for the rest of the economy. So you can just see which parts of the economy you'd probably prefer to be exposed to. And just hearing those comments from the Chief Minister tonight, it just sounds like the Northern Territory is in a very good place to be able to benefit from that Asian income story. Just a little bit more on some other opportunities coming out of Asia. So when China came on the scene, it had an enormous impact on the global economy and also on commodity prices. We don't see a new China on the horizon. People have talked about India as being a potential candidate. It's got a similar size population and the same sort of urbanisation trends. But so far, India's impact on commodities demand has been quite small. But something worth looking at is China's Belt and Road Initiative. So this aims to improve the connections across Eurasia via the Silk Road Economic Belt and Maritime Silk Road. So you can see those in the pink and blue lines there. And so this initiative will capture more than 60 countries, which accounts for more than half the world's population and around 1/3 of world GDP. And this initiative is going to require a significant investment in infrastructure. It's going to be very commodities intensive. So again, that's a positive for Australia. And the infrastructure spending associated with this initiative is estimated to be somewhere between $4 and $8 billion US. So apart from the benefits of the direct spending, there are other benefits from this initiative. It's going to promote increased trade throughout the region and probably also throughout the world. And it also has the potential to increase the potential growth rates for these economies just through the increased infrastructure spending and also through increased trade as well. I'll just quickly touch on some of the risks to the outlook as we see them. So we see that there's a significant risk to the outlook if the lift in business capex that we're just starting to see come through isn't sustained. So going back to that CBA PMI survey, some businesses are starting to report that capacity constraints are holding back output. and the backlog of work is running at elevated levels. So if we don't see businesses lift capex, we can't really make the most of this global economic expansion and the solid domestic backdrop. Another risk lies with the consumer. So we think there are downside risks downside risk to consumer spending coming from stretched household balance sheets and weak income growth. So we've got household debt levels, they're up at record levels, up near about 200% of disposable income, and we've also got wages growth running at a record low 2% per annum. If we add to this mix, we've got significant job security fears at present, and we've also got significant pressures on household budgets from higher electricity bills and that sort of thing. So it's quite a difficult mix for consumers to navigate. It's not really a recent development either. These trends have been in place for several years now, probably long enough to sort of change consumer behaviour. And what it does is it tends to make consumers less responsive to good times. So when you've got very high debt levels and you get some good economic news, a wage rise for instance, people tend to not focus so much on spending that money, but rather just focus on paying down that debt. And high household debt levels also make consumers more responsive to any bad economic news, and that can magnify any downside. We've also got households probably a lot more sensitive to interest rates than they have been in the past, just because of these high debt levels. So that chart on the right-hand side, that shows the household debt service ratio. So that's just showing us how much of your income you need to service your debts. So that last peaked back in 2008, and the cash rate was 7.25%. At the moment, the debt service ratio is only down near 6%, but it would only take a cash rate increase to about 4.25% to bring that household debt servicing ratio back to that peak. So it just shows us how much more sensitive consumers and households are to interest rates than they have been in the past. So I'll just now touch on what all this means for interest rates and the Australian dollar. So over the past year, the RBA spent a lot of time outlining what they regard as normal for key economic indicators. So that chart, the green lines are showing you what the RBA has said is normal for these indicators, and the orange line is showing you where we are now. So you can see for some of them we're getting pretty close, but for others we're still a way off, and particularly we're a way off still for wages growth. That's running at around 2%, whereas the RBA said a normal rate of wages growth is something more like 3.5%. And also the cash rate, that's sitting at 1.5%, and the RBA said a neutral rate is somewhere around 3.5%. So we think that wages growth will probably only pick up very gradually from here. So that means a rate rise is probably off the cards for quite some time. At the moment, we've got a rate hike in our forecasts in November, but probably the risk is that that gets pushed out to early next year rather than being brought forward. And we think when the Reserve Bank does start to raise interest rates, it's going to be very slowly and very gradually. They're going to be assessing how households are coping with high interest rates. We don't think they're going to get back to 3.5%, that level that they have nominated as a neutral rate. We probably think the cash rate will peak somewhere around 2.5%. Just on the Australian dollar, our forecasts are for the Australian dollar to appreciate this year. We've got a forecast of 83 cents against the US dollar by the end of the year. That's just because a supportive global backdrop is very positive for Australia. It's positive for our currency, and also the prospect of higher interest rates here should also help boost our currency as well. I think I'll stop there.